The stock market is a dynamic environment where investors seek to make informed decisions to maximize returns. Understanding the various risks, conducting thorough analysis, and staying updated with market trends are crucial for effective investing. This video provides an in-depth look at stock market risks, analytical methods, and current trends to help investors navigate the complexities of the market. Before starting, don't forget to like and subscribe to our channel The Financial Feed for more future updates. Risks in the stock market. Market risk, also known as systematic risk, refers to the potential for an entire market or sector to decline in value, affecting all securities within it. This risk is influenced by macroeconomic factors such as economic recessions, political instability, or changes in interest rates. Market risk is unavoidable and affects all investments to some degree. Credit risk arises from the possibility that a company or government entity may default on its financial obligations. This risk is particularly relevant for investors holding bonds or other fixed income securities. Credit risk can be mitigated by diversifying investments and assessing the creditworthiness of issuers through credit ratings. Liquidity risk is the risk of being unable to buy or sell securities quickly enough to prevent or minimize a loss. This risk is higher in markets with low trading volumes or for securities that are not frequently traded. Investors can manage liquidity risk by investing in highly liquid assets and diversifying across different asset classes. Interest rate risk is the risk that changes in interest rates will affect the value of investments, particularly fixed income securities like bonds. When interest rates rise, the value of existing bonds typically falls, and vice versa. This risk can be managed by holding a diversified portfolio and adjusting the duration of bond investments. Inflation risk, or purchasing power risk, is the risk that inflation will erode the real value of investments. As inflation increases, the purchasing power of money decreases, which can negatively impact returns on fixed income investments. Investors can hedge against inflation by investing in assets that typically appreciate with inflation, such as stocks or real estate. Political risk refers to the potential for political events, such as changes in government, policy shifts, or geopolitical tensions, to impact market performance. This risk is particularly relevant for international investments. Investors can mitigate political risk by diversifying geographically and staying informed about global political developments. Operational risk involves the potential for losses due to failures in internal processes, people, or systems within a company. This can include risks from technology failures, fraud, or mismanagement. Investors should consider a company's operational risk management practices and corporate governance when evaluating investments. Regulatory risk is the risk that changes in laws or regulations will impact a company's profitability or operations. This can include changes in tax laws, environmental regulations, or industry-specific rules. Investors should stay informed about regulatory changes and assess how they might affect their investments. Stock market analysis methods. Fundamental analysis involves evaluating a company's financial health and intrinsic value by examining its financial statements, industry position, and economic environment. Key metrics include earnings per share, EPS, price to earnings, P/E, ratio, and return on equity, ROE. This analysis helps investors determine whether a stock is overvalued or undervalued. Technical analysis focuses on analyzing historical price and volume data to predict future price movements. This method uses charts and technical indicators such as moving averages, relative strength index, RSI, and Bollinger Bands. Technical analysts look for patterns and trends to make trading decisions. Quantitative analysis employs mathematical models and statistical techniques to evaluate investments. This approach involves analyzing large datasets to identify patterns and trends that can inform investment decisions. Techniques include regression analysis, algorithmic trading, and risk modeling. Qualitative analysis assesses non-numeric factors that can impact a company's performance, such as management quality, brand strength, and competitive advantages. This method complements quantitative analysis by providing insights into a company's operational and strategic aspects. Economic analysis involves evaluating macroeconomic factors that influence the stock market, such as GDP growth, unemployment rates, and inflation. By understanding economic indicators, investors can gauge the overall health of the economy and make informed investment decisions based on economic trends. Sector analysis focuses on evaluating specific sectors or industries within the stock market. Investors assess factors such as sector performance, growth potential, and competitive dynamics to identify investment opportunities. This analysis helps investors understand how different sectors are performing relative to the broader market. Valuation analysis involves determining the intrinsic value of a stock by comparing it to its current market price. Common valuation methods include discounted cash flow, DCF, analysis, comparable company analysis, and precedent transactions. This analysis helps investors assess whether a stock is fairly valued, overvalued, or undervalued. Sentiment analysis examines market sentiment and investor behavior to gauge the overall mood of the market. This can include analyzing news headlines, social media trends, and investor surveys. Sentiment analysis helps investors understand market psychology and potential market movements based on collective sentiment. Current trends in the stock market. Technological innovation continues to drive market trends, with sectors such as technology, artificial intelligence, and renewable energy gaining prominence. Companies that lead in innovation are often seen as attractive investment opportunities. Trends include advancements in cloud computing, automation, and green technologies. Sustainable investing, or ESG, environmental, social, and governance investing, is becoming increasingly popular. Investors are focusing on companies that prioritize environmental sustainability, social responsibility, and strong governance practices. ESG criteria are influencing investment decisions and shaping market trends. Interest rate changes have a significant impact on the stock market. Central bank policies, including interest rate hikes or cuts, influence market conditions and investor sentiment. Recent trends include fluctuations in interest rates due to economic conditions and monetary policy changes. Global economic recovery. The global economic recovery from the COVID-19 pandemic is a key trend impacting the stock market. Economic growth, fiscal stimulus measures, and vaccine distribution are influencing market performance. Investors are closely monitoring recovery indicators and adjusting their strategies accordingly. Market volatility has been a notable trend, driven by geopolitical events, economic uncertainty, and market sentiment. Investors are adapting to increased volatility by employing risk management strategies and diversifying their portfolios to mitigate potential losses. Cryptocurrencies and digital assets are gaining traction as alternative investments. The rise of blockchain technology and digital currencies, such as Bitcoin and Ethereum, is influencing market trends and investor behavior. This trend includes regulatory developments and institutional adoption of digital assets. Remote work and digital transformation. The shift towards remote work and digital transformation has impacted various sectors. Companies that offer remote work solutions, digital tools, and e-commerce platforms are experiencing growth. Investors are focusing on companies that capitalize on these trends and adapt to changing work environments. Healthcare and biotech innovations. Healthcare and biotech sectors are seeing increased investment due to advancements in medical technology, drug development, and pandemic-related research. Innovations in healthcare and biotech are driving market trends and attracting investor interest. Inflation and commodity prices. Inflation concerns and fluctuations in commodity prices, such as oil and metals, are influencing market trends. Investors are paying attention to inflationary pressures and their impact on purchasing power and investment returns. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know if there is any other videos you would like to see. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.